All right, well, we'll get started now. It's 2 o'clock. So what I wanted to let you know about is the first thing I'm going to do is I'm going to probably talk for about 15, 20 minutes to try and give you some ideas of where I see the commodities and resource stocks markets right now and where I see them going in the future. I'm going to try and leave some time open for questions. And if time permits, I'll also talk about some of the companies that I follow closely and why I like them. And I think they're good examples of what I'm going to talk about in the opening of the talk here. So thank you very much, ladies and gentlemen, for joining me today. One of the questions that I get asked often is, when is the market going to turn around? And with the pummeling that gold took and other commodities took earlier this week, or late last week and earlier this week, I seem to be getting that question a little more often. And one of the things that I look at that really gives me confidence about where the market's going is to look at what's happening with supply and demand. And on the supply side, why I'm seeing a lot of similarities today to what I saw in around the year 2000 and 2001. That's when the strongest bull market in commodities ever started. And I see a lot of similarities today to what I was looking at back then. Back then in the throughout the 90s or most of the 1980s and a lot of the 1990s, there was a significant underinvestment in exploration and new mine development. And that created a big weakness in the supply chain of many commodities. And so the supply chain, we're still seeing that weakness today. Even though through about 2003 to 2008, there was increased money spent on exploration and new mine development, it's not nearly to the degree that is needed to replace what the mining companies produce each year, and also to prepare that supply chain for the years to come. If the question was, well, if supply is weak and demand was weak, well, we wouldn't have a very good argument for the price of commodities to go up: gold, silver, copper, oil, uranium, whatever it may be. There wouldn't be much of a reason for it to go up. But where that demand equation gets quite exciting is that in the case of gold, for example, if you look at the China and India, they are the major engines for demand in the case of gold and other commodities as well. As these countries are emerging from, where we were in the developed economies maybe 40 years ago or 50 years ago, the rich are growing richer in those countries, and more people are moving into the middle class as well. And as they move into the middle class, they're consuming more stuff. They're buying more washers and dryers and automobiles and computers and all the things that we enjoy in the developed economies. They're starting to also get in the emerging economies as well. And as they do, they're putting a lot of strain on the supply of commodities. And it's that balance that really has me excited, and the similarities that I see between the year 2000 and what we're seeing today. Now, where I really think there's the most inefficiencies is in the mining stocks, whether it's big or small, gold, copper, oil, silver. These companies are not getting paid fairly in market value, especially for the smaller ones, of what they have in the ground. And as we went through the 2008 economic calamity that slowed down the demand for many commodities, but the reality is that the growth didn't stop. And so we've moved from a base, let's say back in the late 1990s, for demand. It grew dramatically, let's say until the 2008, and it's still growing from there. It's not growing as rapidly as it was before, but the consumers of those raw goods or the finished goods that need those raw goods and commodities to build those products are growing. and they continue to grow, and they will continue to grow as we go forward. Now, we're going to see these cycles of, up and down, but ultimately over time, when you've got a couple billion people that are consuming more and more, that's going to continue to put strain on the supply chain. So I really watch that supply chain. When I'm talking about the supply chain, I'm talking about new discoveries that can be advanced towards commercial production. And that's where I see the weakness. And I can't, when you look at it from that perspective, you can look a long way out. The reason you can look a long way out, it takes time to go from putting a hole in the ground to making a discovery through to being able to make that into a future producer. And many companies have to let's say you start out with 1,000 targets, and you only hit on 100 of them, and then you only have 10 that may go into commercial production. We need a lot more than that to make up for what happened in the 1980s and 1990s with the lack of investment, and also to prepare us for the future. And I really think that what we're going to see happen in the not too distant future, maybe in the 3 to 5 year window, is we're going to have some severe shortages in commodities. And I don't think I don't think the investment world really understands those shortages that are coming up. And why I can stand up here and make that comment with confidence is because I've been following the supply chain for 20 some years, and it's not getting any stronger. Yet, we're seeing the growth of consumers out there that are consuming the products that need the commodities that are in short supply. And I think that we're coming to a point where we're going to have a pretty serious supply crunch that not a lot of people are really being, really keeping a close eye on or really appreciate significantly enough. You can see evidence of that. First of all, I'll talk about how you can see evidence of the supply shortage and the long-term underspending in commodities. Where that comes from is you watch the discoveries that are going into commercial production. And more, if you watch the reserves of the producing companies, what you'll see is that their reserves are going to lower and lower grades. They're going deeper and deeper into the ground to find those lower grades, and their reserves are shrinking. Not only is that happening, but the head grade of most mines are starting to be in significant decline. And this is strong evidence. Like, if a mining company has the opportunity to make a bunch of money off of copper or gold or what have you, and the prices are quite high, the argument is that they should be increasing production right now and doing as much as they can, but they can't. And the reason that they can't is that long-term supply weakness. And it's continuing on now, and it will continue on. I can look out 10 years from now and say with confidence that I don't think that supply chain is getting much stronger. Now, there's more evidence that the investing community out there is not paying close enough attention to what the supply chain, and that's in the prices of resource stocks. If you're looking at the small exploration companies, now when I talk about exploration companies, I'm not just talking about some company who has a piece of moose pasture in Saskatchewan. I'm talking about companies that have put holes in the ground and they found something with their drilling. There's a reason why the drill rig is called the truth machine in the business. And the truth machine gets rid of the hype and the nonsense and the promotion. The truth machine tells you what you have. And when I talk about quality exploration companies, I'm talking about those companies that have gone out there, put holes in the ground, made a discovery. Now, once a discovery is made, the next step is to advance that towards economic evaluation of that deposit. And you're trying to assess, does this have the potential of being a future mine? And then there's another group of companies that have the kind of projects that can advance from being exploration companies, into future producers. Even the producers, if you look at the prices of the big companies, the Gold Corps of the world, the Rio Tintos, the Anglo Gold Ashantes, even those stocks are dramatically oversold right now. But the further down the food chain you look, and in reality, the further down the food chain you look, the more important it is to the future of the supply chain as well. Because if that little exploration company doesn't go out there and find a new discovery, the mining company at the other end doesn't have a project to replace their reserves with. The major mining companies have always been not very good at exploration to find new discoveries. Those small and mid-tier companies are extremely important in the business to make those discoveries. Now, as I said, the evidence that the supply chain is weak comes in the pricing of these junior and mid-tier mining companies. If you look at them, they're extremely underpriced right now. I'm going to give you an example for argument's sake, just so you can understand what I mean by when I say that they're extremely undervalued. Let's take a hypothetical company, and let's give that company a $1 billion gold discovery. Let's say that project is in Ontario somewhere, and it has all the hallmarks to be a future producer. So, a company like that, if a major mining company was going to take over that hypothetical $1 billion gold exploration company, that company would be worth somewhere in the neighborhood of about 10% of what they have in the ground. So this $1 billion exploration company would be worth about $100 million. Let's say, for example, that exploration company has 10 million shares out. Theoretically, they should be trading at about $10 a share. That would give them that $100 million market value. And historically, that's what a major mining company will pay for a gold discovery as I'm describing it. Right now, that similar gold company would be trading at about 20% of $100 million. That's what I'm talking about, undervalued. These exploration companies are extremely undervalued. Even the middle tier companies and the large companies are undervalued, but not nearly as much as the smaller exploration companies and as you move up the food chain. And so if we had a situation where I thought that the price of commodities weren't going to go up, what I would need to see that, to make that argument, would be that either supply increases dramatically or demand decreases dramatically. And we're just not seeing that happen. The supply chain is pretty constrained. It can't really move around. It's not like you can, just because the price of copper is down to $3.10, or the price of gold has come down to $1,300 or goes up to $1,900 an ounce, doesn't mean you can turn production on like that. It takes time. And so that's why I can make these confident comments, is because I watch that pipeline extremely close. And again, it's just not happening where the supply chain is in decline, and I don't think it will be for a long time, maybe 10 to 20 years out before there's a significant change to that supply chain weakness. Now, we've gone through a period where the demand kind of softened up a little bit, and but not anything significant. I would need to see a lot more of a decline to get really bearish on the commodity prices. But if anything, I'm seeing the opposite. I'm seeing that the supply is weak, demand is strong, and now we've got the United States economy. Although the stock market has kind of been taking it on the chin in the last week or so, and I think that it has some more downside. One of my shows that I do a daily stock ticker on 1938news.com. And in there for about the past month or so, I've been calling for a correction, maybe in the 10% window. But even though I see a short-term weakness, before a month ago, I have been very bullish on the U.S. stock market. And why I've been so bullish is that I'm seeing the signs that the U.S. economy is starting to really take hold and looking to get stronger. You can look in the retail sales, you can look in the auto sales, you can look in the housing numbers, and the U.S. consumer is starting to finally open up his wallet again. And it's been since about the late 2008 that the consumer in the United States has been pretty sanguine about buying new stuff. For example, you look at the average automobile in the United States, and right now it's about, on average, about 12 years old. There's a lot of pent-up demand out there, and if you see the average automobile with a long age or old like that, you're also going to see that in other products too, like washing machines and fridges and stoves and stuff like that. And so, although I've been calling for this correction that we've started to see in the last week or so, I also believe that the U.S. economy is getting stronger. So this short-term situation with the economy, I think, is going to be over with fairly quick. The short-term correction in the stock market, I think, is going to be over with fairly quickly, and it'll be the foundation for the next move up. And why that's important to commodities is the U.S. is a big consumer of commodities. And if the U.S. economy gets stronger, which I think it is, it will bring up the economies of the emerging economies as well. And that will help the global economy get stronger. And as the global economy gets stronger, they're going to consume a lot more copper, oil, silver, gold, uranium, diamonds, whatever. Those are the key commodities that I follow closely. But there's plenty of other commodities that are in short supply. And so I really think that this is a contrarian's dream kind of market. You know, most of the time if you ask an investor, are you a contrarian? They'll say, oh yeah, for sure, yeah, I'm a contrarian. But right now we have a contrarian's dream market. And you know why it's a contrarian's dream market? It's a contrarian's dream market because there's no contrarians around. And the best time to be out there buying things is when there's blood all over the street, even if it's your own. If the fundamentals give you a reason to be active. And I think that the long-term fundamentals definitely give us a lot of reasons to be active. And, that's sort of why I'm bullish on on commodities themselves. But when it comes to the resource stocks, I think that those are the best way to buy the commodities that you're bullish on. Right now, you're paying, in some cases, 1/5 of what you should pay for gold in the ground, for example. You're seeing that also with copper and other commodities. And so I'm very bullish on the resource stock space. I wanted to give you some ideas of what I'm looking at. Oh, there was one other thing I wanted to bring into context. If you look at the resource stock space today, the price of those resource stocks is very similar to what it was in 2001, when the greatest bull market for commodities and resource stocks got underway. There's probably 90% of the companies on the TSX venture market right now are trading at less than a dime. These companies with real deposits are trading at significant discounts to what they realistically have in the ground. You look at the index, and the index today is priced just like it was in 2000. But here's the big difference between then and now. At that point in time, gold was trading for less than $300 per ounce. Silver was trading at about $5 per ounce. Copper was trading at about 60 cents per pound. Uranium was trading at $5 to $7 a pound. Oil was trading at less than $20 a barrel. Now we see gold, even though it's corrected $250 or so, close to $300 earlier this week, it's still at close to $1,400. That's significantly more than these companies were priced for back in 2000. And so that's sort of where we've come from. Now going forward, what I'm looking for example, as I was preparing, I wanted to give you some ideas of how bullish I am on the prices of commodities. For example, in the gold price, what I'm looking for is I think we're going to be trading somewhere near $3,000 per ounce in the 3 to 5 year window. I think that we've got, double in the price of gold going forward. Silver, which is right now trading, I think, around $23 an ounce or something like that. I'm looking for $50 per ounce in the next few years. Copper, which is now trading close to $3 per pound, come all the way from 60 cents per pound in 2000. I think it's still got a lot of legs, and we're going to be looking at $5 per pound copper in the next few years. Diamonds are another commodity that I follow and have been very active in over the years. And I think that they're a really good indicator of what's happening with the top end of the consumers out there. And as the India and China are growing rapidly, they've also been big consumers of diamonds. I can't really give you a specific number on where I see diamonds going, but what I do, because they're in different categories, not all diamonds are created equal. It depends on the size, the clarity, the cut, all these various different variables. But I do think that the prices in the various different classifications are going to go up. I'm looking at oil somewhere over $100 per barrel over the next few years. I think this $100 number is sort of a middle term of what we're going to pop over it, we're going to pop under it, and maybe get close to $120 in the next couple years. So, that's how bullish I am on commodities. And again, this isn't some sort of rah-rah cheerleading stock promoter kind of thing for me. This is based on reality of what's happening in the industry. I follow the industry very closely. I follow the supply chain of commodities very closely. And as I said a number of times already, I'm not seeing that the supply chain can get any stronger anytime soon. But I definitely can see the consumers out there, the demand from the emerging and developed economies get stronger. That I have no problem making that argument for. So, on that note, where are we for time? 22. I'm going to take some questions if you folks have some questions. Anyone have any questions off the top of their head? Go ahead.
The venture exchange is around 920 right now.
Correct.
Can you see it going below 800? Where do you think the bottom is?
Well, trying to pick the bottom is always a difficult challenge, and I think that what's more important is to try and get the trend right. And whether we are at the absolute bottom or not, that's hard to determine. But I do think whenever we're at maximum negativity or bearishness or fear out there, which is where we are today, I can tell from the conversations that I have, and it's not just with the average individual out there. I get called from a lot of brokers, other analysts, and I can tell in their voice the fear level. And whenever the fear gets to that maximum level, which I think we're at today, I'm not going to say that I think that it's going to happen a month from now or within a narrow range of points, but I think we're we're pretty much at the lows right now. Another thing that I watch closely is stocks of any kind are just like a commodity. They trade based on supply and demand. The holders of the supply are current shareholders of a company. And right now there's no demand for the junior exploration or even the mid-tiers. But I think that the supply is getting tight as well. I think most people that have wanted to make that fearful trade or that panic trade have already made that trade. And I think for the most part, this latest move down, I can't believe how some of these companies that I follow are dropping. Even the big ones. I mean, Goldcorp is dropping Goldcorp has an average cost of production about $700-800 an ounce. Even at $1,300, they make nothing but money. And they're dropping like they're going out of business. The market is, I think there's lots of evidence out there that we're at maximum fear right now. And I think that we're in striking distance of the bottom if we're not already there, which I think we are. In a roundabout way, I hope that answers your question. Anybody else have any questions? Yes, sir?
Your stock buying, is that a website?
Yes, it is. Thestockvine.com. Just like the grapevine.com, the stockvine.com. And I'm going to have my notes for this talk here on the website, and they're also getting video of this. So, there's not going to be a test at the end of this. You can find all this stuff on our website. I think I'm titling it "State of the Mining," or "State of the Commodities and Resource Stock Markets." So you'll have an article you can find on the stockvine.com, and also the video will be up there probably within a couple days as well. Yes, sir.
You follow the insider reports on what the executives and directors are doing, and what is their attitude towards their own stock?
I don't really follow the insiders that much. My key litmus test has always been, before I got into writing reports on the industry, I worked for mining companies. And I've been really well educated on what to look for from the truth machine, the drill rig. The drill rig is the key thing that I look for. That's what, gives me confidence or lack of confidence. I don't really look at the insider trading reports that closely, although I think that they're, for the investor out there that wants to do that, I think you can get some hints from that. Probably more hints from the buy side than the sell side. People sell stocks for all kinds of reasons, but as Warren Buffett says, they only buy them for one reason. They think it's going up. So if I did watch it, that's what I'd be watching for. Yes, sir.
You talked about a supply problem in the future. Which of these commodities that you follow do you think have the biggest problem with that? The biggest shortage?
Well, the one that could affect our lifestyle the most is probably copper.
Yeah, that's what I was
But you look at China and India, and as their economies get stronger, they also want to consume a lot of gold and silver and diamonds, and so I think there will be a supply. But the one that could affect us the most is in the copper price, possibly uranium as well. Although uranium doesn't have as big of an effect on the production of energy. The amount of uranium that's used to produce that energy is pretty low in the overall cost of producing that energy. So, yeah, I would say copper is the one that could cause...
to make money, then copper would be the thing to invest in.
I like copper a lot. I like gold a lot.
That needs a light bulb needs copper wire.
Absolutely. If they want their computer to turn on and their fridge to work and their stove to work and all those other electrical devices, you need Dr. Copper to work. I see a gentleman over there. He really wants to ask me a question. He works with a copper company that I follow very closely. Give me their question.
I work with Condensing Copper. We have 10.3 billion pounds of copper.
Yes.
$10 million in the bank at the year end, December 12th. We're trading at less than 1/3% for a penny per pound of copper in the ground. What are your thoughts on that company?
There's another example of how I can make the case that these junior exploration companies are trading at ridiculously low prices. The company has money in the ground. They've got a massive deposit. They've got they're in the right kind of a country that's mining friendly. You start checking off the check marks of what a project needs to be a future mine, and Candente Copper has all of those things. And yet the market is treating it as if it has nothing. How close is it to the cash value if you look at the market value of your company right now?
We're trading at less than 1/3 cent per pound of copper in the ground.
There you go. In a normal takeover for a copper deposit by the majors, you're looking at, depending on what the fundamentals are of the deposit, you're usually looking at 2 or 3 cents for that takeout of copper in the ground. As he said, they're trading at 1/3 cent. There's another evidence of how undervalued the resource companies are. And Candente is a great one for you to do your homework on. I've been following Candente for years. I like the deposit a lot. I think it's got a lot of potential, really great people working with the company, and it's a big deposit that we need more copper. And they're just those kind of deposits in mining-friendly jurisdictions are very difficult to find. Yes, you can find them in some places that you probably wouldn't want to travel in, nor would you want to build a mine in, but not nearly, not like that project is.
What are the stocks are you bullish about?
Pardon me?
What other stocks are you bullish?
Okay, how were we for time? 30? I'll make this really quick. I would give you a little brief rundown of them, but we've got to be out of this room right now. So the ones I feel very confident on, and you can find this will be on the list of what I put on the website. Osisko, they're in Quebec. Their symbol is OSK. They're a new producer of gold. They're a low-cost producer. Their production's at about $800 per ounce. They're reaching record production. They're in Quebec, which is a great jurisdiction. I'm very bullish on Osisko. If you're in the uranium space, Fission Energy right now is making a lot of noise. Their symbol's FIS. Why I like that company is they've got a new discovery at their Patterson Lake project in Saskatchewan that looks like I think it's going to be a takeover by a major. It's really high grade. It's close to surface. I like Fission a lot. Premier Gold. Premier Gold is in Red Lake, Ontario, Nevada, and in northern Ontario as well. In all three of those jurisdictions, they've got real discoveries where they poked a lot of holes into the ground and made real discoveries. Their symbol's PG. Another company I follow really closely for copper and gold is Exeter. Exeter's stock symbol is XRC. They've got a very large deposit, and I think it's a world-class deposit. I recently did an interview on my website with the new president and CEO of the company, and you can find that on the stockvine.com. I want you to know that they are a banner sponsor on our website, so they pay us to put banners on the website. But I've always said it doesn't matter if someone puts a banner sponsor on my website. When I comment on them, they still have to go through the same criteria as every other company. And if you do your homework, I think you'll clearly understand why I like Exeter. Another gold-focused company is International Tower Hill Mines. Their symbol is ITH. They've also got a world-class deposit. It's approximately 20 million ounces of gold. It's found in Alaska. It's right beside a highway. It's got power within close proximity. It's really a great project, and they're dramatically oversold. Stornoway Diamonds, this is another sponsor of ours. Their stock symbol is SWY. I just did an interview with their president and CEO today. That's up on the website. I put it up before I came out to do this talking engagement. Their symbol is SWY. Another company I follow is a company called Evrim Resources. Evrim's symbol is EVM. Why I like them is they're called the project generator model. What they do is they go out and get these grassroots projects, try to do some initial work on them, and then bring in a bigger partner that can come in and earn 60 to 70%. And they've got a lot of money in the bank for a junior, and they've got a lot of good projects. Rubicon in Red Lake, Ontario, RMX. This company has a wonderful high-grade discovery. I think it's going to be a future mine. And my time's up there, so I'm quickly going to run through the last. Arctic Star Exploration, they're diamonds. They're a sponsor. Their symbol's ADD. Bear Creek Mining, BCM. That's a silver-focused company. Virginia Mines, VGQ. They're a Quebec-focused company. Andre Goumond runs that company. He's the guy that found the Eleanor deposit that sold to Goldcorp and is going to be one of Goldcorp's future producers. Colossal Minerals, CSI. They're in platinum and palladium, really high grade, great story. And Fortuna Silver Mines is a silver-focused company. FVY is the symbol. And again, you don't need to really write these down. You can find them on my website, thestockvine.com, where I'm the editor-in-chief, and I'm going to have the notes from this, and the talk will be on the video as well. If you have any more questions, I'll be outside the room here. I'm going to get out of the way of the next speaker. Thank you very much for joining me today.